Hey everybody, this is Jose Blasco. How are you, my friends? We are about to get started in just a little bit. Before we get started, as always, it's always appreciated to have a quick confirmation that sound is good, that you hear me well. So the process, very simple one, quick message in the chat box. So I know you hear me, quick hello. It's always nice to say hello, and that way I know you hear me well. So we are ready to start on time. We got 40 plus seconds to go. Let's go ahead and share a few hellos. How are you, Mark? Good to see you, my friend. Good to see you. Very good. Okay, 30 seconds to go and we begin. By the way, Mark, if that's okay, I'd like to ask you to shoot me an email when you have a moment so you can update me on how things are on your end. That would be great. Very good. 20 seconds to go. And we begin. Almost there. Here we go. Almost there. 3, 2, 1. Time to go. Hello, everybody. Welcome to the session. Today is February 9, 2022. My name is Jose Blasco. I will be guiding you through options with options, where we, as the name suggests, look at the marketplace, focus on the options markets, look at different types of options opportunities because options gives options. And therefore, we can greatly adapt to market conditions, either up markets, down markets, high volatility, low volatility scenarios, and more. Before we get started, I would like you to focus and read carefully the disclaimer on the upper left side of the screen. Please read it carefully. Again, this is important information. It's relatively short, so I'm counting on you all to read it completely. It is indeed important, so please do not skip it. Now that this is done, we are now going to move into the agenda, which is a quick reminder. We will look at the market, understand what's happening out there today and what we expect it to happen as time passes and we get into tomorrow, next week, etc. From there, we'll look at reviewing some of the trades we have. Not much has changed since the last session, so I'll do that as quick as I can. And from there, we will move into trade execution, which is going to be looking for new opportunities. And hopefully today, if the market allows for it, I have plans to do a few things that will certainly be interesting for you to see and experience. But anyway, with all this said, let's begin with our market analysis. By the way, before we start, I almost forgot, I wanted to highlight the tradewithufos.com/Jose page. You have the same page ending with the name of your instructor. Maybe you are attending the future sessions with Boyan, or the FOREX sessions with Becky, or maybe you are doing options with Josip, or any other combination with any of your coaches. So you use their name at the end, and in my case, it would be tradewithufos.com/Jose. You come to this page, and the reason why I am highlighting this page is because in this page, you have an opportunity to first click on the purple button to log in, then click on the red button I'm not sure why I said red, on the green button to ask questions. But before you do, and I guess that's why I was mentioning the red color, as you can see below, there are multiple comments coming from different users where other questions have been asked before. So maybe the answers you're looking for are actually already in the page. So make sure you search first, and if your answers are not there, then you can go ahead and type your questions so they will be answered properly. Ahmed, it's very good to see you, my friend. Very nice to see you here with us. Cool. So with this said, again, let's jump into the markets and let's start analyzing the markets with a little bit more detail so we get to understand what's happening out there. Okay, so first of all, we are looking at the S&P. Okay, and similar as what we saw last week, the market today, even though we have a blue color dot, the market is not confirmed. The market climate, I should say, is not confirmed because the dot is thin. It's not a thick dot, or like those blue thick dots. That one is thin, meaning it's not confirmed, which is the same that has been happening since a few days ago. We had a confirmed dot to the downside that was red, didn't go well. Another red dot didn't go well. So you can see lots of uncertainty, which is being identified by AutoClimate. And therefore, trading at this moment in time and be very much directional, like heavily exposed to a direction, based on statistics, based on what autoclimate tells us, it's not the smartest thing to do, isn't it? Because the market is not clearly defining what it wants to do yet. So in that sense, that's one of the reasons why options are great, because we can always do non-directional trades, which is some of the things I'm going to do today. For sure, you can also have and run a portfolio with multiple trades, where some of your trades are long, some of your trades are short. You have hedges in place. So all of those things could make a lot of sense. But again, keep in mind that being fully directional at this moment in time, it's just a bit too soon. We can see as well a little bit of a contradiction if we look closely at these two lines, the blue line representing the implied volatility of the calls and the gray line representing the implied volatility of the puts. So if we look at it carefully, you can see how the put implied volatility is 17.67 versus the implied volatility of the calls is 17.33. So in other words, the puts are winning. So there is some pressure to the downside that we identify looking at options data, while when looking at the candlesticks, actually the color is blue, even though it's not confirmed. So again, two forces pushing in the exact opposite direction. So it's a fight, and it's not defined yet. Therefore, betting too hard on a direction, again, based on the analytics that we are running, based on statistics, would not be the smartest choice, even though, of course, anyone could get lucky. But again, statistics probably is the best information for us to rely on, isn't it? Now, when looking at the volume map, we can see that the fight it's translated to the intraday trades with 17 and 17 for call and put. That's the implied volatility. I didn't say, but if you attend the sessions regularly, on the left, I'm looking at the 3-day average where the put was winning by a bit. When we look at today, which is what I have on the right, so we are looking at exactly equal puts and calls. And exactly equal means 1.1 above average for the calls, above average for the puts. Here it looks a little bit more, but also we got the calls above the average where the puts are not. But everything else, it's between averages. Okay, so again, the market is lacking on a lot of decision, and if any, the bets are being placed very short term, where from now until February 14, which is a few days from now, it seems that the balance is kind of pointing at a bit more bearish, where when looking at February 16, maybe just a bit more bullish. So again, what a fight. It's a very difficult decision to take when it comes to exposing yourself to one direction, if that was your only choice. Luckily, we did with options, so we can do many more things, which is what I plan to do today. Now, let's look at the VIX. So the VIX is currently trading at 2030. Okay, this is the current value for the VIX. The VIX is relatively low. Okay, relatively low. Of course, it's been dropping. It could certainly drop much more. I mean, if we go back to, let's say, November last year, we were trading at levels of 15. So you could argue that 20 is actually not that low, and it's not that low. But definitely we are not trading at levels of 30 or 30 plus. So the VIX has been dropping, which is surprising, because there is a little bit of a fight out there when it comes to going either up or going down. The puts seem to be winning by a little bit, but then the VIX is down by 5% today. So major fight and a lot of contradictory information all over the place. Okay, so what am I going to do today? Well, today I want to trade non-directionally. Okay, but because volatility is very low, instead of building iron condors, which would be a very normal, natural choice that you have seen me employ many times in many sessions in the past, instead I would like to focus on double calendars. Okay, why? Because even though this is absolutely not correct, I will say that the double calendar, it's kind of like the opposite of the iron condor, in the sense that they both collect time decay, but the condor is a credit trade, where the double calendar is a debit trade. So you pay for it. So implied volatility rising will benefit you. With an iron condor is the opposite. Again, there are many more differences, and what I just said is totally imprecise. But again, this is one way to think about it. And as I get into planning the trades, I will obviously be more precise. Okay, but this is one way to think about it. So I'm going to be working on this type of trades in a moment. But before we do, I would like to review the positions that we have on. I want to do this very quickly, and some of them maybe I'm not even going to load the chart, okay? Because we've seen it for long enough, such as Yelp, for example, which is a trade that started moving in against us. We started butterflying it to help with the risk. So notice that if we did nothing, this trade would be losing 218. Because of what we did, we are only losing 160. So again, working on the trade. Hopefully that stock will rally. I remember the break-even point of the stock is 38. We are not close to 38 yet. Okay, the current value for Yelp is 34.8. So we are far from 38. And being February 18, the expiration date, so it's looking like this trade will end up the way it looks like. Okay, but again, we'll monitor it for a little longer. Same with Lennar Corporation, which is a stock that went against us in a massive way. Again, beauty of options. In this case, it was a bull put spread, so the risk is limited no matter what. I did miss my chance to butterfly it, if you recall. I do believe some of you did, so your risk profile would be better than mine. Qualcomm is another trade, and that one I will load the chart. So Qualcomm, okay, that one is a trade that I commented on last week. Okay, I'm not sure what day was that, but we were talking about if that stock keeps rallying, so you'll have an opportunity to get out at a very, very good exit point, because currently what we have with Qualcomm is a form of an iron condor. If I graph it, you can see that the more the stock rallies, the more you're going to profit. And of course, the maximum profit would be obtained more or less in the middle here, which at this moment in time, this would be an anticipated profit of $125 or something like that per contract. And if time passes a bit more, it's going to be so much more, up to $470. Now, in the past week, in the past session that we did, I did leave an order in the system for Qualcomm right here, which was an order to close this butterfly, to close this iron condor at the midpoint of the spread with a condition, okay, which was, I'll load it here so you can see it better. So the condition was that Qualcomm was going to be trading at above or equal to 192.5. Well, little bit of a teaser, Mr. Qualcomm, because when you look at the chart, you can see how the chart went on February 3, which is exactly 3 days from now. It went all the way to 192.10. So it didn't hit 192.50. Therefore, my order was not triggered and I was not executed. But certainly, if you were watching this carefully, and given the current pattern of implied volatility on this particular trade, where you can see that we are above the red zone. While we are in red zone territory, our dotted line is above the red zone territory. And this has to do with the behavior of implied volatility since we entered this trade, given the fact that we enter in two shots. So, my expectation would be that when you hit 190 plus something, if you were watching this, probably you would have seen a profit greater than the one that is simulated here. And probably you could have decided to exit this trade manually. I would indeed have done it if I was watching this, even though I remember saying that I would use an order this is the first time I was doing this. I was using an order here with the instruction mark plus 0. So it's a limit order taking the midpoint between the bid and the ask, okay, and placing an order at that point. So you get exactly the midpoint of the spread, assuming you get filled. And when doing so, of course, you want to watch your trades, because you may not get filled. If you use a market order, for sure you get filled, but you also get slippage, okay? So in any case, it is possible, and I'm not sure, feel free to comment on the chat box. It is possible that some of you maybe had found a way to exit the trade during any of those 2 days, okay, either on February 2nd or February 3. From then, that stock went down and now it's come up. So again, certainly it would not be a crazy thing to do to decide to close the trade and collect. In this case, it shows $70 of profit. I guess the spreads are a bit wide and the simulation is not showing the same. If we look at Qualcomm here, it shows 60. So again, depending on where you look at the market data and how the P&L is calculated, we see a bit of difference. But again, nothing wrong with looking at closing the trade or getting ready to close the trade. Certainly, I would monitor that, because it would be a shame now that we have it in profit to let the profit go, and maybe you end up with a trade that end up losing, because if that stock doesn't rally, notice how the red zone shows a maximum loss of $30, which is not like it's a lot, but again, being now in a plus 60, plus 70, plus something profit, ending up in minus 30, is something that I personally would not welcome at this stage, because we are in damage control mode, isn't it? This is not a trade that worked well in our favor. We converted this initial bull put spread into a butterfly. Again, let me say that again, into an iron condor, and therefore we are in damage control mode. So I don't want to be greedy and shoot to make the whole profit here. Any consideration for exit starting from now makes a lot of sense given what we have accomplished so far. And thank you for confirming that, Mark, that you exited this trade with $51 of profit. So that's well done, good management. Which of course it requires to be on top of these trades, especially when we are dealing with damage control modes. Okay. Now, since we are meeting tomorrow again, I'll leave it open. I may review it tomorrow and see what we do. So far, I'll leave it alone. But certainly, if not tomorrow, into next week, very, very likely we would be closing this trade. Okay. EOG is another trade I won't load because that stock moved so much against us, so it doesn't make sense anymore. And then Fedex. This is the one trade I would like to discuss as the last one. So I'll just show the chart of EOG very quickly. As you can see, we shorted at this point, and that stock went all the way in the opposite direction. So again, there was an opportunity on that day to move the trade to damage control mode, and then you will be in a profit. I didn't do it. So in my case, the most I can lose, I think it was $90. I think it was the spread. That was a hedging trade, by the way. So the most you could lose is 90. So it was not a big deal at all. But again, you had an opportunity to convert that into a small profit if you did it on that day. So Fedex, which is the last one, Fedex is an underaction trade, is an iron condor. And when we look at Fedex here, so we could see how implied volatility and historical volatility both have calmed down big time. Because if we go back in time to just a few days ago, okay, so let's say here, for example, so actually a bit more, okay, like for example, on this date, so you could see how the implied volatility line, the red line, was crossing the below purple line. Now, time passed, and not only time passed, the market moved up, which obviously puts you more centered in the purple area, which is great. But then the market went down again. But even though the market is going down and more or less trading at the same levels where we were before, notice how the red line is far away from the purple line all the way here. So there is all this width, all this difference now that was not available before. And that's because there is much less implied volatility built in those options. And therefore, it's now theoretically helping for this trade to be moving way closer to a profit outcome instead of a risky outcome. So far, this is current day. You can see how the top of our cone and the bottom of our cone using March 4 expiration, which is the expiration of this trade, is clearly between the purple lines above and below. The purple line above is here. Okay, and with all of this said, so there is nothing to be done. Just to wait and keep monitoring this. Of course, we are clearly in the bottom part of the purple area. We are not in the upper part at all, or we are not in, let's say, the middle part. We would be somewhere here. We're not. So in other words, the bottom part may be a risk again, and if that's the case, we're going to have to act on the management of the iron condor. Maybe tomorrow. If it's tomorrow, we'll do it together, or maybe next week. If it's next week, we'll either do it together or review it, depending if it happened while I was doing a session or not. But anyway, all of this takes care of our review of the trades that we have, as well as the market analysis, and therefore it is now time to get ready to find new market opportunities. Okay, so guys, I would really appreciate on the chat box if you could very quickly just share with me a quick confirmation. I am sharing, by the way, the feed. Okay, so that way you're going to be seen on the video stream. Okay, so now don't be shy just because I said you're going to be seen. But please go ahead and confirm that all is good. If something is not good, just tell me, hey, Jose, can you repeat, can you review this? If all is good, just type a quick okay, a quick all good, whatever it is that we do. But please give me some feedback. I'll take a sip of water and we go. Thank you so much, Joe. Thank you so much, Mark. Wonderful. It's appreciated. Very, very nice. Perfect. Thanks for your participation, guys. This is always very important for me and, all of your coaches. Okay, it's critical that we interact. Anyway, so the plan for today, right? So the plan for today is to find a few non-directional trades, okay? But again, the type of trades that we want to find are not trades with an increased volatility, because volatility is not increased, it's decreased. So instead of looking for non-directional trades with high volatility conditions, okay, which ideally you would be looking at iron condors or variations of it, we're going to be looking at trades where we can exploit a market which trades in a range, but at the same time where volatility conditions are low, so we can enter the trade knowing that we pay very little for the options, so we can get the benefit of profiting from the range. But on top of that, profiting from the range, meaning not profiting from a specific direction, but just for having the stock do not too much. But then also profit from the fact that as volatility goes back higher, those cheap options we would purchase today will gain value, and then we're going to profit more. And all of this is, in the meantime, by absorbing time decay, which is going to be very little time decay, because if the options are cheap, the time decay is going to be little. But we're going to do it repeatedly every week by using very short expiration options that expire every week. So every week we keep tweaking, rolling, meaning that every week we collect new premium from those weeklies. Okay, and that basically, in a nutshell, is a double calendar. Okay, and in order for me to start looking for a double calendar, the settings I'm going to use on the matrix are going to be almost copy paste compared to what I would use to do an iron condor. To use an iron condor, I would be using implied volatility mean to be greater than 80%. So to do my double calendar, I'm going to be looking at implied volatility mean lesser than 20, right? And if I do that, of course, it's a pretty extreme condition, so I'm gonna get a limited amount of stocks, especially the moment I add my list of penny increment options, okay, even shorter as a list. So again, no worries about that, because we may need to change that in a moment, okay? So far I got a few. We're gonna change that. But again, I just want to review everything. So I'm looking at cheap options. I'm looking at nothing in the stock filter area. I'm looking at strength to be neutral for the daily time frame and neutral for the weekly time frame. Exactly the same I would do for the iron condors. And earnings, I'll start with exclude 15 days, but I may work with the dates a bit more intensively here. And then nothing when it comes to the stock price range, and nothing when it comes to the auto climate. Okay, so really the key here is the strength to be neutral, meaning that we expect the stock to remain range bound somehow for a while volatility, while options premiums are cheap. So I'm going to scan for that, and I end up with these particular 5 results. Okay, so let's go ahead. We got April 19 expiration, April 27, April 26, April 26, May 5. All of those are the earnings date. And to be honest, I feel it's a bit far away. It's a bit far away. April 19, that is like over 2 months from now. It's, again, remember, I want to, when I build my double diagonal, I want to do it in a way where I'm going to be selling the weeklies, and I'm going to be buying long-term options, which suffer less time decay, versus weekly options, which enjoy a faster rate of time decay, because I'm going to sell them. That's why I said enjoy. But also, I want to make sure that I do it. I want to make sure I use an expression there which is far enough so I can sell weekly options multiple times. But also, I want to make sure that the expiration date I'm going to use to buy the options is lining up with the next earnings date, because what's going to happen when that next earning date approaches typically is that the options premiums will rise, and that will kind of offset the problem that from now until that date, these options I'm going to buy are going to lose time decay. I'm going to lose premium because of the time decay effect. So if that premium is going to be kind of like recovered, if you wish, I'm going to simulate that so you will understand better. But if that premium that is going to be lost because time passing is going to be recovered, because as earnings approach, premiums tend to rise, and that's almost a sure thing for most of the stocks. So this is really going to be very helpful to recover that time value left loss, maybe even make a profit. And in the meantime, for multiple weeks, we've been selling weeklies. Okay, and all of this is now kept in our pocket. So therefore, I want to go far out enough, but at the same time, if it's too far out, so the further away I go, the higher the probability that our trading range is going to be violated or broken, because the wider the range is, the longer the time I expose myself to price movement, the greater the probability the stock will at some point start moving crazy, right? So in other words, I like to find a balance, right? And of course, the chart will tell us where is the balance. I'm going to start with those 5 symbols, but that's why I said that in the earnings tab, there may be times where you, instead of using exclude the next 15 days, you may come in here and say, you know what, let's go ahead and include specific dates, starting from, let's say, I want at least 3 weeks from now. So 1, 2, 3. So maybe I'm gonna start with March 4 expiration. That's the minimum. So I can sell weeklies at least 3 times. And then as an ending date, well, yeah, I'd like it to be further out, of course, but at the same time, that further away may be a problem, because also the further away the options are, the more slippage you're gonna get and things like that. So maybe I'm gonna just set that April 22nd, April 15th, because it's the third Friday of the month, which is the monthly. You know what? I'll go for 16. That way I make sure the 15 is in the equation, and then I'll click the scan, and then my list may be shorter. Here we go. So the list is shorter by doing that, but now I'm being a little bit more targeted. Okay, and if any, I always can come back to the prior list by changing it to exclude 15. So now my list is nothing, right? So what do I do? No problem. Remember, we have 3 techniques on how to search for volatility. So technique number 1 was mean greater than 20. Technique number 2 is mean greater than mean less historic volatility below 2 standard deviation. So when I do that, still nothing. And my technique number 3 would be, which that one I would expect it to provide some results. So top percent decrease in the last 5 days. Okay, and now we got some results. Okay, so now we have something to work with that may be a bit more adequate for me to find things that may be a bit more efficient, that allow me to exploit a range without having to wait like 3 months to be able to exploit the range. And now I got 3 months of price movement risk and have trades in my account for 3 months that I need to manage for 3 months. Nothing wrong with that, by the way, because it's a very relaxed management, but at the same time, I guess you get my point. So we'll start with JP Morgan, okay? And we look at the chart and see what happened with JP Morgan. So we can see how earnings on JP Morgan is happening on April 13. So if I was to do a trade on this particular asset, I would be looking at my statistical range, probability cone, okay? And that would have me draw a couple of lines. So starting from here all the way to the current date, and starting from here all the way to the current date. Okay, so this is the statistical range that basically, if I was to move my chart to the right, so you can see it more clearly now. Here we go. So we are talking about a range from 183 to 131. This is the statistical range for JP Morgan. Okay, now you can see how some extreme, very fast speed movements that happen on that stock are generating historic volatility values, which are humongous, and are bringing my blue lines to be so far away from the red line. So obviously that very wide statistical range is absolutely not ideal for a trade of this sort. But again, I'm just gonna take a look at this more in depth in a moment. And guess what? I'm just gonna discard it, because as you can see, I just moved to a monthly time frame, and you can see how the statistical range is pointing at an area where there is no data. The highest candle we have in a monthly time frame is here, and because there is no data overhead, then there are no UFOs, and if there are no UFOs, then it's like, basically being blind, and I cannot plan a trade unless I use hope, which we don't. So I'm going to move to the next one. SRPT, I would expect it not to be too liquid, so I'm just going to be looking at JD, okay, and see what happens with JD. So with JD, we got earnings happening on 310. So I would be using 311 as the expiration date for the options that I am going to buy. Notice here is the opposite, right? So in normal cases, we're always looking in an iron condor, I should say, not a normal case. Like in an iron condor case, we are looking at expiration dates prior to earnings. In this case, we are looking at an expiration date which is right after earnings, lining up with earnings, so we can take advantage or benefit from that increase of volatility. Okay, so if we look at the statistical range in this case, so we are looking at from here to here. Okay, also notice the red line being inside the blue lines, which is telling us implied volatilities are cheap. Okay, if the red line is beyond the blue lines, it means there is more implied volatility built in than what the speed of movement of the stock itself reflects. Okay, so in other words, that's another way to think of cheap options. Okay, now same story. I'm just going to move to the monthly time frame to see where we're at. And yes, with the monthly time frame, we can see we have market data here, so I should be able to define a range. Let's find out. Yeah, let's find out. Where could that be? So we are talking about loading data all the way to November or something like that. So let me narrow this down. Okay, so first of all, we got 49% probabilities. That's good because our methods for non-directional trading require 48% or more. So the nearest UFO that we have beyond that line is that UFO. Okay, so we are good with that one. And below, sorry, I just draw a line there that I didn't want to draw. Here we go. So, and below, it doesn't seem that we have anything. Okay, but the reason why we may not have anything is that maybe I don't have enough data loaded. Let me take a look. Yes, I need to load data all the way to somewhere here. Okay, so let's go ahead and load more data. So I'm going to use 10,000 bars. Here we go. Still nothing below? Wow, interesting. Okay, so let's go ahead and load 20,000 bars. Okay, no, 10,000 is the maximum. Silly me. No problem. So we're going to move to the 89-minute time frame. This should bring in a bit more data below price. Let's see if that's the case. So data is being loaded now. I kind of have the feeling that maybe earlier when I was doing the 55-minute time frame, maybe data was not loaded because it didn't take that much time. Let me go back to the 55-minute time frame. No, it seems that it was not. Yeah, it was not. Okay, so, okay, back to 89. My bad. So just loading the chart. Here we go. So we have the chart. Now, below price, we have nothing. This is quite strange. We have price here, 2020. Wow. So the algo, when applying the algo to JD, the algo is not happy with the UFOs it finds below price because it's not plotting anything below price. Wow. So I'll try 233. This is going to be my last try here. And if we don't have UFOs below price, then I cannot define a range, isn't it? So then we'll move to the next stock symbol. Okay, well, we got 38% probability on the 233, so It's not gonna work, and still no UFOs below price. So yeah, um, we are gonna skip JD, my friends, because auto UFOs identifies many UFOs, but not that low, meaning that potentially those on-field orders have been canceled, and therefore we are not going to trade that. Okay, so we're going to check Wheaton Precious Metals Corporation and see if this one will allow us to trade. So when we look at this particular chart, so we can see earnings happening here on May 5, which is, no, sorry, no, I was looking at the wrong earning date. Here we go. 310. Okay, so 311 is the date we can use. So 311, again, let's do the same process one more time. Right here. Okay, now notice here how the implied volatility is higher. The red line is beyond the blue lines. I am not overly concerned about that because, again, we scanned for greatest drop in the last few days, and as you can see, there is a great drop of implied volatility, right? So there is a nice drop. Okay, so I am not overly concerned about that. Okay, and during earnings reports, volatility tend to peak. So good enough as long as we have a range. I mean, it would be better to have the red line inside the blue lines, but it's not that critical. Okay, also because remember there is a volatility skew effect. Not all expiration dates behave the same. So I'm okay with that. Not a big issue. So anyway, so moving back to the 55-minute time frame and looking for UFOs above and below price. So far we got 49%. So this is good. Okay, so above price, the next one above price will be located here. Okay, so that will be the one. And below price, let's see what we have below price. The one below would be located here. So that's it. We got our range. It was quite easy in this case. Not so easy in the prior case where we didn't find the UFOs below, but in this case we did. Okay, so here is basically the statistical range that we want to exploit. Okay, so if I put my mouse and current date and I create a box from now until all the way March 11 expiration, so this purple area, it's our bet. Okay, this is the purple area. So now how can we profit, okay, from within that area using a double diagonal? Well, the first thing that we're going to have to calculate is we're going to kind of break this into 3/3. Okay, 3/3. So you got the upper third, okay, then you got the lower third, okay, and then we'll have the middle third. Okay, so what we're going to do is we're going to calculate those 3/3, and wherever we have the those separating lines, which is coinciding with that third area, what we're going to do is that we're going to buy a call and sell a call at that area, and in the bottom part we're going to buy a put and sell a put. So notice that when we do Iron Condors, we typically sell the calls above the range, sell the puts below the range. I mean, not exactly below, like outside, but somewhere around that. Where in this case, we go all the way in the middle, but not in the center. We go in the middle, but using that 1/3 position, okay, that 1/3 position. And the call we buy and the put we buy are going to be using that March 11 expiration, which coincides with the earnings, where the call we sell and the put we sell are going to be using weekly expiration, and we're going to be doing that every single week, okay, repeatedly every single week. So let me put it together so you will have a better understanding of this trade setup, the pros and the cons, and how it's going to work. So first of all, we said that for WPM, we're going to use March 11. This is the expression I'm going to use to buy. That's it. Okay. And then I want to ideally use February 11, 18, 25, and 4. So I got 1, 2, 3, 4 options to sell my weekly options, even though realistically February 11 probably pays you nothing at all. Also, that stock is a $41 stock, so it's not very expensive. So we may need to start with February 18, okay? I'll check that in a moment, okay? If you don't mind, I'll do that in a moment. Now that I know I'm going to be using March 11 and February 11, which probably won't work, and we need to work with February 18. So now that I know my expiration dates, I need to calculate my thirds, okay? So the top part here is 48.32. Let me bring a calculator. So 48.32. The bottom part is around 35, 65. Okay, so minus 35.65. So we are talking about a $12 range. And if I divide this into thirds, it's talking about a $4.2 piece. Okay, every one of the range is 4.2. Sorry, Mark, I'm just reading your comment now when you said how many bars. I was using 10,000 bars on the 55 minutes. I believe you are referring to JD, I believe. So 4.2 would be the size of, sorry, not like this. 4.2 would be the size of the bottom third. 4.2 would be the size of the middle third. And 4.2 would be the size of the upper third. Okay, assuming I did that perfectly drawn, you get my point. So again, if the top part is 48 something, right? If the top part is, what did I say, 38, 48, 31, okay? So that places the upper part around 44, okay? So 44, okay? So would be, the upper strike, assuming that exists on the option chain. So for now, I'm just gonna put it there. And then the bottom part, okay, is going to be around 39 something, okay? 39 something. 39 plus, okay? Again, I need to check what's available on the option chain. So 39 plus is more or less here. 44 something is it's more or less here. Okay, and again, if you think about it, so this is your upper third, middle third, and bottom third. Now, the more precise we are, the better. But again, precision will, in the end, be determined by what's available on the options chain, typically by the longer expiration, especially if it's weekly. Okay. Mark, got you. With WPM, I got 10,000 at the moment. Okay, 10,000. So, yeah. So why the longer expiration date will typically determine the strikes we're going to use, because remember, we need to use the same strikes. So let's say we were going to use the 44. So then we would buy the 44 call that expires in March 11, and we will sell the 44 call that expires in the shorter weekly expiration date, right? So that we need to use the same strike for the call we buy and the call we sell. So let's say on the longer expiration date, you have the 44, but on the shorter expiration date, you don't, or vice versa. Then you cannot use the 44. You may need to use the 45, or you may need to use the 43, or whatever is available. Maybe it's $2.5 strike price increments, depending on the stock price as well and the liquidity. So all of these things are to be checked, and typically the monthly expiration dates are the pickiest of all when it comes to setting strikes. And also, the further away you go in time, normally you got less demand, therefore less strikes available compared to the front week or the front months. Okay, so as a rule of thumb, keep that in mind. In any case, you need to check both. So good news for the upper one, we have the 44. So I'm going to check mark the 44. Okay. And when it comes to the bottom one, we need something 39 plus. So it seems that we have the 39. Okay. After 39, we got 40. We don't have 39 and a half. So I guess that 39 would be our choice. And if we do that, so we're going to construct a trade here. So buy the 44 call and sell the 44 call. So this will be done by control click on the ask for the 44 call using March 11. So this is March 11. Okay. So control click. Okay. So notice now I am buying 44 call on March 11. I did control click the first time to reset the trade setup I am setting up on the top. Okay. Now that I use control click once, now I'm just gonna click without control because control resets. Okay. So then what I'm gonna do is I'm gonna look at February 11 and sell the 44 call, right? Because I need to buy the 44 call using March 11 and sell the 44 call using the front week. But what happens here? That one only pays you 2 cents. Okay, so we're not gonna do that, which is what I was thinking what would happen. We're gonna check February 18, okay, and see what February 18 pays us, which is now 18 cents. So let's click on that. So we pay 141 and we receive 18 cents. Then the midpoint actually is 21 cents. So this is the call side. And on the put side, okay, we're gonna be dealing with a 39. So we're gonna be buying the 39 put, okay, and pay 76. And we're gonna be selling the 39 put, okay? So let me write it down. So buy 39 put expires in March 11 and sell 39 put that expires in February 18. So this is the trade we have done. With the put side, okay. On the call side, we've done the same, but it's not calls, it's puts. Okay, so we are buying the 44 call and we are selling the 44 call with the same expiration dates. Okay, so this is our double calendar. Okay, this is a calendar above, this is a calendar below. Now, would that make sense to do this trade? Would that not make sense? What's the risk? What's the reward? Let's analyze and let's conclude if we're gonna take it or not, or what. So I'm gonna right click now on risk graph so we can graph it and get to understand our trade. And I would say it looks pretty okay. Okay, let me explain this risk graph because it's certainly difficult to understand. So first of all, notice that with a risk graph of this sort, where we are combining expiration dates, it's often impossible to calculate certain figures. It's often difficult or impossible to calculate certain figures, even though you will understand the mechanics of this trade as I point at a certain thing here. So first of all, notice that there is a moment in time. So if the stock is currently trading at this price level, right? So if the stock was to fall and 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 fall, you lose money, but there is a moment in time where the most you can lose gets limited. Okay. If the stock was to rally away from the range, then you also lose, but notice that there is a moment in time where the most you can lose is also limited, right? So notice that on the upper side, it looks like the limit is 117.49, and if I move higher, it's gonna be a bit more. On the bottom side, it's already flat at 119, and guess why it's 119? Because the cost of this trade is 119, and because it's a debit trade, if you pay 119, what's the most you can lose? It's 119. Okay, it's 119. Of course, if you let the weekly expiration dates expire, for example, you leave the February 18 44 call alone, and that stock rallies, and after February 18 you are above 44, you're going to be assigned short shares at 44. Is that increasing risk? No. Why? Because you still own the 44 call against the short stock position, so your risk is limited, just like you can see on the graph, no problem. The issue would be if in the last expiration date you allow yourself to go ahead and be assigned, and now the next option expires, so now you're exposed to gap risk on Monday, the Monday after, and that opens the door to mathematical unlimited risk. Okay, but we're not going to do that. We'll talk about trade management. We got until March 11 of time to talk about this. Okay, so we're starting with a risk of $119. That's the worst case scenario. Again, per contract, if you do it twice, it's twice. If you do it 5 times, it's 5 times. Now, when it comes to profit, notice that if the stock stays within some sort of a range, there is green above. Okay, there is green above. Okay, but also, if the stock stays where it is, you can also end up losing, meaning that this area here is red. Okay, how come can you lose if it's a non-directional trade, right? How come can you lose if the stock stays in the range? Well, the reason why you lose is because what the P&L is showing you is the P&L until February 18, which is until your short units expire. But after those short units expire, what are you going to do? Well, you're going to sell new units, and then new units, and then new units. So every time you sell, you are going to be taking that debit of 119 down. So today we are taking it down by 21 and 14 cents. Okay, we are doing this in the middle of the week. So if you do it at the beginning of the week on Monday, it's better. Or even if you do it on the Friday before the weekend, is even better, even though now you have an impact on margin. The theta is positive, Joe. Theta is positive. Okay, the theta is positive because the rate of time decay of the short units is faster than the rate of time decay of the long units. Okay, so the theta is positive and the vega is positive too, which is the whole reason for this trade, to be exposed to an increase of volatility. That's going to pay more than the time of the rate of time decay, even though the rate of time decay, that's a sure thing. Okay, it's one of the few things which in trading are going to be us for sure, especially if you wait until expiration. If you close it before that, then maybe not, because the value of the options may change based on their extrinsic value. But if you wait until expiration, extrinsic value is gone no matter what. So then that time decay is yours. So anyway, so again, the reason why we see red below is because of that, because we are selling February 18, but remember, we are not going to be done there. Okay, so after we sell February 18, right, then we're going to go ahead and sell February 25 and then sell March 4. Every time we do it, we're going to be collecting more premium. Okay, we're going to be collecting more premium. And this will bring the levels of efficiency of the trade to be much better. So we are basically going to be reducing the risk every week. Okay, and while we reduce the risk every week, we are bringing that red area a bit higher every week to a point where it may or may not become green, but it will tend to become green, especially if there is an increase of volatility, which I'm going to simulate here below. Okay? I'm going to move this, and as I move this, watch. So this is 36%. Okay, 36%. Now we saw that when that stock reports earnings, let me add earnings here. So add study earnings. Thank you very much. So when that stock reports earnings, okay, volatility went here to 39. Here went to 36. Here went to 39. And this is from levels that were lower levels of 36 to 39, that's 3%. From here to something lower, it's like 32 to 36, that's 4%. From here, which is 39 to somewhere lower, it's 35. So from 35 to 39 is 4%. So in other words, we are now at 36. If that was to be the bottom, which possibly it could be, so when it goes back up, we should expect 3 to 4% increase. That will bring it up to around 40%, which to be honest is more because this is an overall understanding of volatility. But remember, the expiration date that have the earnings built in normally experiences a greater increase than the average measurement of the implied volatility, the CIV, the continuous implied volatility for the stock. So in other words, worst case scenario should be 3-4% increase. So what happens if we get 3-4% increase? Well, if that 36 becomes, let's say, 40, I went too far, somewhere here. So 39.8, notice what just happened now. The whole thing is green above. Okay? And again, if you add to this the fact that every week you're going to be selling new weeklies, so not only you are increasing the green zone, you are reducing the risk, bringing the bottom line higher and higher and making that red zone to be narrower. So you reduce the risk, you increase the reward, but also as you increase the reward, you widen the break-even points. Okay, those break-even points are then widened, okay, further beyond where they are now. Notice if I type 36.84, good enough. So the break-even points are 38.4 below and 45 above. If this increases to 39, so now the below one is 38.2 and the above one is 45.3. So you can see we have increased by like 30 cents or something like that what the break-even points of the trade were. So there are multiple variables here that we cannot control, especially the increase of implied volatility. But guess what? Because we are using the expiration date, March 11, which lines up with earnings, that is, I mean, I hate to use the term a sure thing because there's nothing sure thing in trading, but it's a very high probability event to see implied volatility rising as we are approaching earnings. And that, with the fact that we also have another very high probability event, which is collecting time decay when you sell options, the two things together combined are making this trade a pretty interesting opportunity, which I am validating at this point for us to execute in the Think or Swim account, which I'm gonna use in just a moment. Okay, so the trade is validated. Now, this is a trade which is more advanced / more complex compared to other trades that we have taken before. So I like to get a bit of feedback from you guys when it comes to how is it going? Were you able to follow? Was it too advanced? Do you need me to repeat something? Was it not advanced enough? Is there any particular additional conversation you would like to have to understand this trade a bit better? Please let me know. And by the way, also notice how you can have individual legs in your simulation. Okay, so if you really wanted to take this to the next level, okay, when it comes to simulating, okay, you could certainly look at. You see the colors. You got the blue and the purple. Okay, the blue and the purple are the ones, okay, that you traded on March 11. Those are the ones that will likely increase their volatility as earnings approach. So the blue is currently trading at 36. So let's say that becomes 39. And the purple is currently trading at 37. Let's say that becomes 39. Okay. So this is your PNL, now a bit more precise than before. Okay. Where again, you can see that improvement on all this green area becoming wider, no more red in the middle of the range. Everything is green within the range. And again, all of this is without counting on you could simulate this by making the other ones to be zero, right? Because those are gonna decay for sure, and then you're gonna add more to them, okay? And it doesn't allow me to go to zero, but we did one, okay? So you get my point, right? So this is probably a good way to understand this trade a bit better. Mark, you are with me, you understand? Okay, I see that some of you remain silent. Maybe you are thinking about it, maybe you need to review it with the recordings. I get you if that's the case, but again, we got 4 minutes to go. I only have time to place the order, and certainly I have time to repeat whatever needs to be done. I don't have time to plan another trade, but repeat I do. So please go ahead and let me know. And even if we're meeting tomorrow again, isn't it? So even if you want to take the question to the next level, I'm happy to address it to the next level tomorrow, but at least I would like to know if you have any concern or question, if you like this trade setup, this trade strategy, this approach, or you don't. If you feel it compatible with what you do or you don't. All of this, it's important for me to know so we can support you better, okay? Cool. Okay, so let's place an order here. So we are using WPM. Okay, so we're going to be using March 11 and February 11. Okay, so I'm going to start with March 11. Okay, so we're going to go ahead and this was the Qualcomm trade from before. Okay, let's delete. Okay, so we're gonna buy the 44 call from March 11 and sell the 44 call. Sorry, February 18, not February 11. Here we go. And then we're gonna be selling the 39 put, and we're gonna be buying the 39 put. Okay, so this is our 119. Okay, and I'm gonna confirm and send. See if I get it at 119. And if not, I will rectify it until I get it filled. Okay, so currently trading at 119. Real-time prices suggest 118. So I should be able to get it. Of course, you can see some of the strikes are less liquid than others. Okay, 46 to 75, 64 to 122. I mean, that one is a bit problematic. Okay, there've been no volume today. Okay, so of course, the issue with March 11 is that so far there is not many people trading it. The beauty, though, is that as earnings approach, there will be people trading it, and this will also help with the increase of volatility. So you gotta take your time to negotiate it. WPM is not the most liquid stock in the S&P, but indeed, if you are patient and you get filled at a valid price, it is indeed a valid trade to take. Okay, so let me try to cancel replace. So hopefully I can get filled. I'm just gonna move this to 125. Just do this quickly for myself, so I can then have it filled, and I know I can review this trade for you in the future sessions. Not yet. So just please don't do what I'm doing, as you have seen me do that in prior sessions. I'm just basically opening the door to be filled at whatever price, because to be honest, what I care about more than the outcome of the trades is that you guys learn, so you can then find your trades, use the tools, and kill it by yourself. Okay, so you don't need me. So yeah, so it's taking a little bit of time there with the lack of liquidity. We saw volume zero in some of the strikes, and that's the reason why. Again, probably in a real account, I would think that you may be filled already, precisely because volume was zero in some strikes. But in the simulated account, it's trying to simulate market conditions and it's not giving it to us yet. So I'll keep working on this. We're reaching the top of the hour, so I guess we need to say bye now, and I will see you tomorrow again. Okay, I just got filled. Actually, I got filled at 119. Okay, well, thank you very much. So, okay, let me document this so you see me document it so you know how it's done as well. So I'm just going to edit the spread. I'm just going to select fill price, fill price, fill price, fill price. And 44 call using March 11. So that is 93. So 93 and 61. 93 and 61. And then we got 22 and 13. Sorry. 22 and 13. Okay, this should be fine. Yes, 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 yes. Okay, good. Perfect. So this is my 119. And now I'm just going to go ahead and click, right click, I should say, copy positions to the clipboard. And I'm just going to drop it on my positions panel below the FDX trade, so I can work on it on the future sessions. Very good, my friends. We are done with today's session. Just out of curiosity, I'll add a couple of vertical and horizontal line there, so we know this is where the trade was taken as well. And we will keep talking about this. You got filled at 116. Joe, you got filled at 119. Wonderful. Wonderful. Yes, I kind of knew that with real market conditions stuff simulated, you will get a better price. Fantastic. Great, my friends. Thanks for joining me today. As always, as you know, it's always a pleasure and great joy for me to conduct the sessions, a few times a week. See you tomorrow again. Bye-bye then. Ciao, ciao.